You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, our monthly update video series for July 2013, and on today's show, the Insurance Industry Update with special co-host and millennial marketer, Eric Palmer.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. With me today, the millennial marketer himself, trolling the net for insurance news, Eric Palmer. Hey, Eric.
Good to be here.
Well, it's good to have you back. All this week we've been having Eric, and we're going to be talking about a lot of things. One of the things we did last week was, remember, we had the final sometime in May, all the carriers had filed with all their state jurisdictions. So they created the convention blank, which I always find that as a euphemism. You know, you're calling your financial document the convention blank. Somehow that doesn't work for me. But if you've seen it, and if you've never seen it as a young person, you should order one just so you can see what it looks like. It's huge. It's like a ledger. It's like their Bible of finance. And it's Blue Book. That's why they call it the Blue Book. And on page 29, 20, 28, in that area are a lot of the financial issues. And if there's bad boy assets in there, that's a nice place to play. But don't have to do that. What we've done is, of course, our good friends at EBIX have put together Vital Signs. And when we did this show, we talked about the Blue Book balance sheet. We have people now, after the vocabulary came out, think about this, that actually took the balance sheet and said, you know, Steve, I don't really feel like I have to be beholding anymore to the rating services. I'm actually kind of getting what to look for here.
Right.
And why do I bring this up now as a newsworthy item of insurance? I think this is the kind of thing, if you're playing in a high-end business area, estate planning, affluent clients, you kind of got to know your way around the balance sheet so you can look at your competitors. Well, what they did was they brought a vocabulary list to this. And why am I bringing this as an insurance update? Because I just mentioned this, and we were requested by so many people said, Steve, send me the ratings and the definitions of all 6 ratings, and send me the vocabulary for the 4-page summary sheet of the convention blank.
What's interesting about that is you're absolutely right. You know, we got to start paying attention not to what the rating itself says from the rating companies, but actually what does it mean when you're looking at risk-based capital. You know, how many dollars to every dollar they bring in are they putting in reserves, and how much cash are they sitting on? What are they investing in? And if you can really read that roadmap, you'll understand whether or not you're dealing with a strong financial company. You know, most insurance companies that have the most competitive products today, both life insurance and annuities, are not A++ companies. They're the companies that are sitting around an A- excellent with an AM best, or even a B++. But take a company like Forethought Life, for example, they've got an A- with S&P. With AM Best. But when I look at their balance sheet, they're over 500% RBC. Now, most companies have to be about 2.5, right? 250. They're over 500%. So that's a huge number. That's a lot of cash capital just sitting on the sidelines. That's a company where I'd like to be with, because that means they're doing something right. So again, it's nothing to just take it for granted what those ratings actually are. You really got to dig into the numbers and understand where's the money, where are they investing, and what are they getting in return.
And to that point, I have to say, after my 30 years, I've noticed a propensity for certain surveillance rating systems to ding annuity carriers simply because they don't do life.
Right.
And they don't reserve the same. And so they look at their asset valuation reserve, their AVR and surplus, and they go, oh, well, you know, we're going to have to lower our rating. But if I take the balance sheet of a lot of annuity carriers, like when you're talking about Athene, and I just bring it to CPAs, and I just say, hey, are you comfortable with this balance sheet and everything? And nobody ever says, no, I'm uncomfortable, especially you just said 500% over risk-based capital ratio.
Right.
I mean, come on. So to me, that's big. Let me just say, just as a side note, and I want to get into this because next month I'm going to have Bobby Samuelson in here, but there is maybe some troubled waters brewing because we have carriers right now, and one of the parts I look on the balance sheet here, especially on the Blue Book, is how much do you reinsure?
Right.
You know, you hold what you can, you retain that, but how much do you outsource? Do you reinsurance treaty? And I've noticed that there are certain carriers, and Bloomberg just wrote about this, that there are certain carriers that are actually reinsuring their own stuff. They open up a company in another state and they reinsure it and they back it with a letter of credit.
Right.
So I'm thinking, like, what's going on with that? And that could be a problem because, going back to your point, if you took their reinsurance letter of credit in that state and you added it to their normal balance sheet, that total may be below the RBC requirements.
Exactly.
Now, see, to me, this reminds me of Steve living through the early 1990s with First Exec Mutual. Ben, this is the thing. Now, to be fair, the industry is working on this. They see this as a problem. We can't take the kind of public heat we've been getting in the New York press.
Right.
So you're going to see a lot more changes on this, hopefully. I hope I can say good things to you somewhere around Labor Day about this.
Right. Well, those letter of credits they're coming from strong financial institutions, but again, it's a warning sign that we need to pay attention to what we're doing. It's almost like the problem that we see overall in the markets, all the margin debt. Everybody's buying on margin. It's almost the same concept. You're reinsuring on margin in a sense.
Yourself.
A letter of credit. So it's interesting. I really hope we get our arms around it because we can't afford for that to be reflected upon the whole industry.
We cannot take another black eye. I mean, the early 90s was devastating, and if everybody remember when we were back there, it was really a problem. Another thing I want to bring out, though, and we talked about this earlier on in Monday's show. If you missed Monday's show, we did an expose on Genworth. Why? Because they have come up with, in my view, one of the most innovative index annuities, and Eric actually made a visual. I need a visual. I can't understand all the mechanics and the math behind it. And he actually made a visual. If you missed Monday's show, I want you to go back out to our site at www.thebiz.tv. Order that PDF. We'll send it to you, and you will see what we're talking about. So I just want to, as an insurance update, these guys are hot right now and innovative.
Right. Well, that product, it gives you an opportunity, or there's two products really that we highlighted. There's a 5-year and a 7-year index annuity. But they've got this strategy called the Cap Max. Again, when interest rates are as low as they are, insurance companies have to become innovative to drive value back to their clients. The Cap Max strategy does it. You got to watch the show and see what we're talking about.
Yeah, I want you to order the PDF because I think it really maps it out and makes it easy. I can't imagine a consumer hearing our explanation on this and going, I got it on the first pass. So we've created a PDF, and I think you'll really appreciate it. Eric kind of did it, a little custom-made idea to help you understand the Genworth product. Hey, we're going to continue our insurance industry update for July 2013 with Eric Palmer. And don't forget, you can enroll in our IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the Biz blog for the Backroom Technician 30-day free trial offer to access the best needs analysis, client education materials that address almost every financial planning scenario. Remember, yours truly, I'm a contributor to Backroom Technician. And just a heads up, before moving forward with any of the ideas you ever hear on our show, always consult your tax advisor, your legal counsel, as well as your broker-dealer compliance officer if you're so FINRA licensed. Now, when we're talking about our insurance update with Eric Palmer, Eric, now this is a little surprise. We did see first quarter total all annuity sales were actually down. And by the way, we're talking about qualified plan first quarter.
Right.
See, that was a surprise. What really surprised me, and it wasn't down a lot, but I would use the word more flat. I saw first quarter index annuities were just a little flat, a little below the line.
Right.
What's going on in that?
I'm coining it as like the great American freeze, but I think what really is happening is a day doesn't go by where something in the media talks about Bernanke's choice is to he's either going to hold back on buying another $85 billion of bonds a month, or he's going to continue to do it. Quantitative easing is coming to close, or it's not coming to close. The Treasury goes up. There's so much news out there that we're all sitting back and we're waiting. We're back to the fence sitting we were doing many years ago when the 2008 first happened, and everybody was wondering what's next. I think there's a lot of wonder out there. So do I buy right now? But the interest rates are a little bit low. If they come back, they could be better. I think there's a lot of people out there that just don't know what's going to happen. But as advisors, as insurance professionals, we have to remind our clients about time value of money. It's not growing sitting in your cushions. It's not growing buried in the backyard. You've got to do something with it. And if it's sitting in a bank CD right now getting taxed on top of just a 1.5% or 2% rate of return, it's not doing you very much good. So, with short-term products like the 5 years we talked about, and even shorter than that, you have to take advantage of educating your clients so they understand that just sitting back and waiting because you're not sure what's going to happen is actually less effective than making a decision and just moving forward with it.
Well, I'm not a supro economist, but if I still see unemployment ticking up, I think Ben Bernanke and everybody's going to have to pull back. I think one of the issues that the Fed was doing was he wanted to shepherd the transition from quantitative easing and starting to see interest. I mean, listen, the Treasury is up 60 basis points, so it isn't like it's flat, it's going up. And some people are already calling us because of that saying, hey, what's the new fixed rate? Well, those haven't really moved yet, but you're going to start seeing some kind of movement if that happens. But I say, you may see quantitative easing back. If we get unemployment numbers that keep going up, I don't think they're going to be able to bail on this and transition us out.
Well, what's interesting, and again, this is, I listen to all the different economists out there, and we read a lot of the news too, but there's a lot of common themes in understanding what the effects are of too rapid of an increase of interest rates. And if anyone's familiar with the high frequency trading, institutional trading is what's driving the market today. The S&P has been going up for a long time because of high frequency trading. And we have a great graph. It's actually an animation from 2007 to the end of 2012 that will show you how high frequency trading has increased over the last several years. And what that ultimately means is that if institutions are getting their money at zero and are able to invest and even make 10 basis points on it, they're gonna make a lot of money. And that's what's happening right now. Well, if interest rates go up, they're gonna start doing that and they're going to start loaning that money back out. So you're going to have this sort of major effects on the global economy. And if we don't have the frequency trading going on, we may see a shock in the stock market or shock in overall markets, which could be bad or detrimental to the economy. So I think the Fed's nervous about going too fast. You have to kind of ease back into that interest rate increase, and you can't overinflate, otherwise it'll drive a lot of other variables, including the unemployment like you mentioned, and some of the stuff I just spoke about.
Well, we're always looking at this because it impacts our industry. I mean, our annuities, our positions in our life insurance, especially indexing. So we're going to keep looking on this. I have another article, and I want to specifically ask Eric just because it's his generation. I've noticed now that a lot more the younger insureds are not going to qualified IRAs and 401ks. They're actually punting and doing Roths. Now, what happened there? I mean, why is this desertion? I mean, did they just come up one day and say, my effective tax bracket is so low, this isn't worth doing? Or, I mean, how did that happen? And would you do that?
Well, at this point, I don't know if I would personally do that, but I think that there's been an interesting flux in just general marketing. Let's think about where millennials or younger investors are hanging out. They're watching ESPN. They're watching channels on television or online that are showing marketing ads from places like E-Trade, where they're telling you to go out and manage your own money. Let us help you manage your own retirement, or a self-managed IRA, for example. So there's already been a focus on get away from some of that stuff like a 401k and start paying attention to what we've got here. And when you go to those websites or you talk to those advisors, they're pitching Roths because of the tax advantages, because taxes are the bell ringer for everybody right now. We all know that taxes are high, and I believe that if you asked a room full of 1,000 people, are taxes going up, staying the same, or going down, everybody knows that they're going up. We have to have them go up, otherwise we can't support the trillions of dollars of debt we've created. So with that said, everybody's interested in taxes. It seems like a Roth would be a great place to go, but I challenge that because at the end of the day, there are too many variables still working against you with a Roth as compared to things like insurance today. Now, Roths are great. They offer great advantages. You have the capability of taking the income out tax-free just as you would in say, a life insurance product. But you still have to choose an investment inside that empty file folder. Okay, so what are the investment options right now inside of a Roth? You can choose a fixed annuity, but if I'm 25 years old or I'm 30 years old, I need a flexible premium because I'm putting a little bit in over time, right? Well, if I look at the interest rates available today and even a flexible premium annuity, it's probably not so attractive. And if I'm young, I feel a little cavalier, I want more than 2%, right? So I'm going to be more attracted to the market, which is a lot of the choices that are being made inside those Roths.
When you think about it, this whole change of thinking about Roth versus qualified plan, that's a generational change. And just one little heads up, speaking about 401ks, the big scary thing I see coming now is people took out loans. And those loans cost money. And they're trying to transfer to different companies and different IRAs and getting taxed on it. That's the new one. Well, remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.